On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So, before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Hope you're all well. I wanted to talk today about the Japanese share market. I've had a lot of questions about Japan. Why is the share market in Japan doing so well? What on earth happened back in the day to cause such a volatile period of underperformance, and where might the market go from here? So to do that and to try and answer some of those questions, we do need to do a bit of a history lesson, so bear with me. Several share markets have hit new highs during the first few months of this year. It hasn't just been Japan. We've seen the S&P 500 in the US top its previous record, which came 2 years ago. European and UK shares both surpassed the highs of 2022 and 2023. And the Australian market, the ASX 200, surpassed its mid-2021 peak. But the most significant milestone of all probably came in Japan, where the Nikkei 225 index, which is a famous Japanese share market index, it finally retook the level that it last reached in 1989, 34 years ago. So what on earth was going on back then? Japan really did have a rock star economy in the 1980s. There was new infrastructure, there were productivity gains, all of that happened in the decades following World War II. Very high quality goods were being produced in very technologically advanced factories. That saw the economy boom. You also had very reliable fuel efficient cars being made in Japan, and they were a global hit after the oil shocks that we saw in the mid 1970s. And all of that helped fuel a massive property and share market bubble. So the Nikkei index tripled in just 4.5 years, which is amazing. Tokyo real estate was reportedly selling for more than 350 times its equivalent in Manhattan. At the very peak, it was reported that the land under the Imperial Palace in Tokyo was notionally worth more than the entire state of California, which is pretty amazing. Now, at the same time, in the early 1980s, the US dollar had strengthened a lot, and that had made Japanese goods even more attractive to American consumers because they could buy many more Japanese goods with their strong US dollars. And that put huge pressure on the US manufacturing sector because it made it much, much, much less competitive. And it also led to a very large trade deficit in the United States. In 1985, at the Plaza Hotel in New York City, the world's biggest economies agreed to do something about that. And that was the Plaza Accord, which was an agreement to weaken the US dollar. And it worked. The US dollar fell sharply against the Japanese yen, as well as several other major currencies, the French currency, the British pound, the West German Deutschmark, as it was in those days. Remember, this is before the euro came into being. So that all helped the US trade deficit, the US dollar weakening, but it then hurt Japanese exporters and it pushed Japan away from dealing with the US and encouraged Japan to do more business and trade more with other parts of Asia. And to offset that more difficult export environment, this is in the 1980s, remember, Japanese policymakers introduced much more expansionary monetary and fiscal policies. And that was seen to contribute to the sharp rise in asset prices that you were already seeing. So that bubble ended up bursting in 1990 after that massive run up through the 80s. And after 1990, you saw property prices and share prices fall into a slump that lasted the best part of 30 years. So the Japanese share market, the Nikkei, fell more than 50% in the 2 years following that bubble bursting in 1990. And at the 2009 lows, this is in the GFC, the Nikkei 225 index was down more than 80% from that peak, which came, I think, on the very last day of 1989, actually. Over that same period, Japan has also suffered from deflation, and deflation is when prices are falling. So it's essentially when the inflation rate is negative. Could say that it's the opposite of inflation. In 12 of the 35 years following 1985, consumer prices in Japan went backwards, and the inflation rate over that whole period was just 0.5%, 0.5%. Now, in the US, it was 2.5% since then, or over that period, I should say, and in New Zealand, it was 2.9%. So just 0.5%, and 12 out of 35 years, prices went backwards, calendar years, that is. And I don't think we saw prices go backwards at all in New Zealand over that period. Sounds better in theory than it is in reality. Deflation isn't nearly as good as it sounds. When prices are falling, people just stop spending money and businesses become very reluctant to grow or invest. Everyone starts hoarding cash. Your economy grinds to a halt and it becomes an extremely difficult hole to climb out of, which is why it's something central bankers really try to avoid happening. So while the rest of us have been trying to knock inflation on the head these last few years, for the past 30 odd years, Japan has been trying to create some inflation, and it's just starting to work. Japan saw its inflation rate rise to 4.3% last year. That's the highest it had seen since 1981. And Japanese inflation now sitting comfortably around that 2 to 3% level. So that threat of deflation looks to be over. And we saw some good signs for the future too in this regard. Japan's largest union group announced stronger than expected annual wage negotiations in March of 5.3%. So those are the biggest pay hikes that we've seen in more than 30 years in Japan. And that was enough for the central bank, the Bank of Japan, to raise interest rates for the first time since 2007. That just happened last month. First interest rate hike since 2007. And that comes on the back of 8 years of negative interest rates. So up until a few weeks ago, Japan's had negative interest rates. Everyone else has got an OCR or a cash rate or a policy rate that is at the highest levels we've seen in decades. They've been very much the opposite. So that move to a more conventional set of monetary policy settings has increased investor interest in Japan. And after a very strong performance last year, which saw the Nikkei 225 index surge 28.2%, that's even more than we saw from the mighty US market. Even the US market didn't go up quite that much. So after that super strong 2023, that's continued into 2024. Japanese shares are up another 20% in the first 3 months of this year, in the 3 months to the end of March, and they've stormed through those previous highs. So, what happens next? Well, it's hard to see the gains continuing at that pace. That certainly can't happen, and especially if the Bank of Japan keeps normalizing monetary policy and raising interest rates just as everyone else is cutting rates. That could strengthen the yen from the current levels, which are still very low. That could add to headwinds for exporters. We also need to remember some of the other challenges that Japan is facing, such as demographics with the aging population or its enormous government debt. Then again, the rally in Japanese shares hasn't happened only because of that massive stimulus and because we've had this extended period of a weaker currency boosting the export sector. We have seen a notable increase in governance standards. The Japanese government has looked to reduce corporate cross-shareholdings between companies. It's pushed for more independent directors. So you've seen a definite increase in levels of corporate governance standards, which is a real positive from the perspective of investors. Valuations also look quite reasonable, even after those massive gains of the past 18 months. The Japanese share market is trading today on a price earnings ratio of 15 times, which is in line with its 2-decade average, the 20-year average, and that's still well below 20.4 times for the US market, despite earnings growth expectations for the next 12 months looking very much the same, about 10% for both markets, Japan and the US, yet Japan is trading at about a 25% discount to the US. And in some ways, that's fair. The US is the biggest market in the world, the biggest economy in the world. It is home to the world's best businesses. It is home to the world's best companies. So it should trade at a higher level than many other markets, Japan included. But Japan still doesn't look too bad, both compared to its own history and compared to where other markets, including the US, are sitting. Perhaps most importantly, Japan, which represents about 6% of world share markets, which is not to be sneezed at. Japan is finding its way back onto the radar of investors after being completely ignored for decades. Some of these recent positive developments might see Japanese shares increasingly included in portfolios as a diversification opportunity following the strong moves we've seen in the US and a desire from many investors both in the US and elsewhere, to have a much broader range of holdings and to have more regions covered. So, could Japan keep performing well? Look, I think it absolutely could. It won't repeat the gains from last year or from the first 3 months of this year, I suspect, but there are some genuine changes and developments that are taking place that do make it worth a look. So, if that's something that interests you, definitely worth having a conversation with your advisor about whether there are opportunities for you in Japan, whether that's a region you should be holding in your portfolios, and the best way for you to get an exposure to that part of the world. All right, thanks all. Thanks for listening. We'll talk again soon.